They're going to crash everything. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, you're seeing in real time the Fed make one of the biggest policy mistakes in monetary history. And in their effort to bring inflation down, they're going to crash everything. And many are wondering, why hasn't this crash already started? Well, I'm going to show you why in today's show and what to look for. Let's head over to Bloomberg, where we picked today's story up with a headline: U.S. inflation cools down again, giving Fed room to downshift on rates. So let's look at the setup here. The overall consumer price index fell 0.1% from the prior month, with cheaper energy costs fueling the first decline in 2.5 years, according to the Labor Department. The measure was up 6.5% from a year earlier, the lowest since October 2021. So what we're seeing now is inflation start to slow down. Now, we said this would happen on the show, and I want to note that they mentioned the energy prices, because this is key to what's going on here and how that is a leading indication that inflation is falling. Here you can see in this chart, consumer price index for all consumers in blue against U.S. regular formulations for all formulations for gas prices in red, both on a year-over-year rate of change. And I want you to see how gas prices in red are leading broad inflation lower. Now here you can note that gas prices are at around 0% year-over-year rate of change. And historically, if we go back and look now, what that correlates is to the CPI running at 2.5% inflation rate. Of course, we know the Fed's looking at its target at 2%, but what we can see with the energy sector right now, we're on our way to 2%. So you start to see the setup here is the Fed is making a big mistake because they're not looking at these forward indicators and saying, wait a minute, where is inflation likely to head, and what do we need to do in terms of monetary policy to anticipate that direction? Excluding food and energy, the so-called core CPI rose 0.3% last month and was up 5.7% from a year earlier, the slowest pace since December 2021. Economists see the gauge known as the core CPI as a better indicator of underlying inflation than the headline measure. And that's simply because food and energy are rather volatile. So the Fed likes to look at the core here and say, if the core is trending lower, then that means broad-based CPI should follow. Well, let's take a look at a chart and see. Here we have the consumer price index again in blue against the core CPI, which excludes food and energy in red. And sure enough, we see kind of a peak here in the core CPI. If we're talking chart terms, we would say that's a double top, but in inflation terms, we actually see this occur in other times. And what that is, it's an indication now you can see in the past core CPI heading lower, and that is indeed going to lead the broad CPI down. So again, we're seeing indications the Fed is setting up a big policy mistake here, because what they should likely be doing, what we should expect them to do, is at least now on February 1st at their next meeting, pause in terms of future rate hikes and maybe even start to set up lowering interest rates. Let's take a look now at a breakdown of the CPI and see where inflation is coming from, because you'll note now we're seeing a lot of pressures that say this peak inflation is indeed behind us. Here we can see from the Bureau of Labor Statistics, energy leading the month-over-month decline at minus 4.5%, with gasoline down 9.4% month-over-month, fuel oil down a whopping 16.6%. From the energy side, if we look at all those items here, most of it is from piped gas service, rising 3% month-over-month. What we can note is that should start to alleviate itself, because there were some shutdowns in the natural gas sector, and that should help a lot. Let's go down to the core. What do we see leading the way down? Used cars and trucks minus 2.5%. Shelter inflation. We talked about how this is sticky in terms of a sense that it's a lagging kind of move, because the Bureau of Labor Statistics makes this number up, but we should expect to see this start to cool off. So everything is indicating that in the months to come, inflation should continue to slow. It may actually pick up steam to the downside. But what does that mean from the Fed's perspective? Well, we think they should keep their eyes open on this and be ready to adjust, but they're not. The data, when paired with prior months' lower than expected readings, point to more consistent signs that inflation is easing and may pave the way for the Fed to downshift to a 0.25% hike at their next meeting on February 1st, suggesting the central bank's work is far from over. So again, rather than look at where this trend is going and say, wait a minute, maybe we did actually tighten enough, maybe we should just step back for a little bit and give the economy a chance to settle here, maybe even just for a few months. No, what we're hearing now is even experts suggest the Fed isn't done. They're going to have to go 0.25% and continue to do that. And so let's take a look at what the Fed's going to say here. But before we do that, many people keep asking, why is the market still pushing higher here? And aside from major shocks, what you see, it's machine positioning. Again, CTA-Timer Pro, I'm going to keep it at $20. On Monday, it's going to go to 30. So here you can see the equity positioning on the fast signals are buying. That's why this market isn't selling off. Barring some massive shock that flips these machines down, they're going to continue to buy this and pull up the longer term signal. You see the NASDAQ, they're still short, but they could drive higher. You want to know why gold? Well, we said on this report, gold, you should be long. The report said it. Now you're seeing it look to break 1900. Fed's Harker supports smaller 25 basis point hikes going forward. So here again, we see in the headlines, the Fed is saying, look, we don't think we're done. And just because the CPI isn't at 2% right now doesn't mean it can't get there. And I think that's the problem we have with the Fed is they over tighten, then inflation comes back down, goes through their target to the downside, and next thing you know, they're cut as fast as they can. I expect we'll raise rates for a few more times this year, though. In my mind, he says, in my view, hikes of 25 basis points will be appropriate going forward. And that decision, what you're hearing right now, and we're setting up this, how the Fed is going to break everything. You're going to see that here in a moment. But I want you to see that they don't think they're done at all, and they're going to keep going. And that is the problem. They're going to continue to attempt to tighten into a market, at least in terms of an economy, that's saying, no, we don't need this to be tighter. In fact, you may have overdone it. Fed officials see interest rates rising above 5% this year and staying there until 2024, a fantasy only projected by those on the FOMC board. But policymakers stress the central bank has still more work to do to tame prices, and they're not anticipating rate cuts this year simply because they can't look to the future. They're stuck in the past. But as we know, of course, the yield curve says, no, Fed, you think you're going to keep cutting, but you're going to keep hiking, but something is going to make that change in terms of your view. Something in the data is going to shift. And here we can see the federal funds rate against the 10-year, 3-month yield curve, something we look at regularly on the show. And again, we note that in periods of massive inversions, this one being the worst in the data series on the Fed database, what we can say is it tells us the Fed is indeed done. So perhaps while they're talking hawkish at the February 1st meeting, something is going to change their view. Let's dig a little deeper. At some point this year, expect the policy rate will be restrictive, says Harker, enough that we will hold rates in place to let monetary policy do its work. The Fed official said he's not forecasting a recession at all, and he expects unemployment rate to rise about 4.5% this year before dropping to 4% over the next 2 years. So again, he thinks that they're going to have to hike some more because we're not restrictive. We're seeing it in the leading indicators. We're already there, and he's already telling you what I've been mentioning. They want to see people lose their jobs. They're expecting people to lose their jobs, and then they're gambling. We're not going to see a recession. Now let's take a look at how they're going to crash everything, including the CPI. We come back to that 10-year, 3-month yield curve, and we can note when we overlay the consumer price index, now shown in red, when the curve steepens, it doesn't mean that the CPI can't continue higher. In fact, we could at some point see it bounce off of this downward trend and go higher before it comes crashing down. And that's what the bond market is saying, is when you see the blue line steepen, it means rates are falling. Here again, you can see, of course, rates falling as the curve steepens, CPI coming down. here you can see going into the great financial crisis, the curve steepened. We saw a transitory increase due to oil prices before the CPI went negative. And then we saw it again going into the pandemic as the curve steepened once again. And then you'll note, of course, the CPI came down. So we're seeing the setup here for the CPI to crash. But what does that mean? As I mentioned, now you should say, wait a minute, if they're going to crash inflation, they should be crashing the bond market or in terms of interest rates and the stock market. You got it. Here we can see that curve steepener now being applied to 30-year Treasury yields. In red, you'll notice the curve steepens. As I mentioned, rates go down. So what we can expect is while most investors believe rates are going higher, you can see as the curve steepens, that indeed means rates are falling. So from this deep level, it's likely at some point we're going to see the curve reverse and rates start to fall, suggesting in addition to inflation, the Fed's going to crash rates. And on top of that, how about stocks? Well, of course, what we can know is at least if we go back to the dot-com bubble, stocks started to sell off their peak when the curve steepened. But since then, we've seen a shift. Curve steepeners or falling rates have been seen as bullish by the market. Well, we can actually see new all-time highs as we saw going into the great financial crisis. We can see that going into the pandemic where a curve steepener led to another high in the market before it came down. So from an investment standpoint, if you're looking at the stock market, you could make the case where this bear steepener in the yield curve could actually send stocks higher and possibly back to new all-time highs. But what is that one thing I mentioned that investors are overlooking in terms of why the stock market can go higher? Why isn't it crashing yet? Well, that answer is in unemployment claims. Here we can see last week in unemployment initial claims dropped to 205,000, just down 1,000 from the week before. How about continuing claims? 1.634 million, down 63,000 from the week before. Now let's look at this perspective. We take the Wilshire 5,000, we'll have it in blue. The total U.S. stock market will overlay the 4-week moving average of initial claims to smooth out that data point. And what do we note? That when claims are low, stocks can still rally here. And you can see even though people are bearish, as long as claims remain relatively low, even if they tick up a little bit, stocks can go back. And again, you start to see what happened going into the great financial crisis. It wasn't the yield curve. It was the fact that the economy in terms of unemployment claims remained low. We can see that here again going into the pandemic. While they weren't at all-time lows, they were very close historically to where their recent trend was. That kept stocks up, and now they're remaining low again. So the one thing investors are overlooking here as they remain very bearish is stocks can grind higher because the machines are going to trigger this thing up. Plus, unemployment claims low or stay low. You don't normally see the stock market sell off until there's a marked move higher in initial claims. And we'll be watching that and letting you know when. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.